audience. So today to start what we call as what the income statement or profit and loss statement. That's the first topic that we are going to discuss about, and I'm going to take you through a template of it, how you can do it as an SME, so that maybe even without any accountant, you can also do something on your own, so that it will be guiding you small in order to make anytime when you hire a professional accountant to do the work for you, it will be easier. You understand? And it wouldn't cost you much, since you are able to put together the necessary information. So we are going to start with the income statement or the profit and loss statement. So kindly try and follow me. Yeah. So when it comes to your income statement, this one is a template of your monthly income statement, and this one, it means that you've done your proper records in terms of your daily sales records. And I think in our previous class we discussed about the daily sales record. We've already done that, so I know that by now you already know how to do your daily sales record. Okay, so the figures, that data, okay, you are going to build this monthly income statement based on that data, the daily records that you get. Okay, because after keeping that data, at the end of the month you'll be able to know the revenue that you've made. That's the turnover or the sales that you've made within that month. That's the revenue. Okay, and at least maybe you'll be able to also know your total cost. Okay, and we've already discussed a lot about this thing, so we are just going to go deeper in. First thing that we are going to talk about is your revenue. Okay, so every income statement, they come in different forms depending on your business model. You understand? So we are going to use this one as a template, so that maybe if you also have any other details to add to it, then you can do that. And this thing is not applicable to all businesses, especially most SMEs. If they've not started paying tax, maybe that side will be blank. And maybe if you are alone and you are not paying salary to any worker, to maybe the labor cost side too, you may exclude it. You understand? Social security, maybe you've not started paying any social security, that one too. Yeah. And maybe depreciation. Okay, depreciation cost, if you are not keeping any fixed assets, maybe this one may not be applicable. You understand? So I'm just going to take you through all the terminologies here before we do practical example. So the first one is your revenue. Okay, the revenue is simply your total sales or your turnover within the month. Okay, so after you've done all the total, you've sum up all your sales within the month, it becomes your revenue or your turnover. You understand? And then so turnover is simply your revenue or your total sales within the month. Then the next one is cost of goods sold, and I think this one I've already explained last month, whereby I said the cost of goods sold is about I cited an example whereby anything that contributes to the cost of the particular product that you are selling, okay, it becomes the cost of goods sold. For I cited an example with a laptop. Okay, that when you go to maybe you buy a laptop from Accra, as you are bringing it, means that you are paying transportation, maybe you pay offloading or whatever cost that you incur in order to sell that particular marketing cost, whatever cost that contributed to the sales of or the production of that product, it becomes your cost of goods sold. So you understand? Yeah. So now we have labor cost. So the labor cost is about any workforce, okay, any cost that you incur in terms of labor in order to produce that particular product or to solve that particular product. For instance, maybe if you are paying for offloading, you are paying for packaging, those who are doing packaging for you, any labor that you incur before you sell that particular product. Okay, you sum it up, you are going to have your labor cost over here. So now we have your social security cost. So that's the social security cost is about SNET. Okay, yeah. So the amount that you pay monthly to SNET for your workers or yourself, it becomes your social security cost. And then we have what we call depreciation cost. So assuming maybe with the depreciation cost, assuming maybe you buy a laptop, okay, like this to use in your office. So you have to first determine the value of this particular product in terms of money. So for instance, maybe the current value, the store value of that particular product is maybe 2,000 cedis. You understand? So you determine how long you are going to use that particular fixed asset. You understand? So you determine how long you are going to use it, and you divide that value by the number of months that you are going to use it. So for instance, maybe that laptop it costs you 2,000 cedis, and then you are going to use it for 10 months. You understand? So that 10 months, you divide the 2,000 by 10. It means that every month you are going to, how much is it going to cost you? So that one becomes your depreciation cost. So any fixed asset that you use at your workplace, for the production of your goods and services, okay, that one, so you attribute a particular cost to it, okay, and then monthly cost to it, and it becomes your so every month you have to deduct that one, okay, from your income. You understand? So we call that one depreciation cost. And then we have owner's salary. As the owner of your business too, you have to pay yourself, okay, at the end of every month, so that you can separate your we call it owner's salary or personal salary. So you pay yourself a certain amount of money, okay, that you think it will sustain you within the month, so that you will not be tempted to spend the business of money. You understand? So you have to separate your personal expenses from your personal salary from the business of money. Because if you don't do that all the time, you'll be taking money from the business, and you end up spending your principal capital. You understand? Your principal. So a portion of your profit should be you should assign a particular amount to, as your salary, even though you are the owner of the business. Okay, yeah, that is what we, the small business owners, we normally face it. Okay, yeah. So let's go to other operational expenses. So the operational expenses or the operating expenses, that one we call it overhead cost or overhead expenses. So that one is a cost that's not directly related to your cost of goods sold, okay, but it's necessary, okay, it's necessary so that it can help you to do your business. For instance, maybe when it comes to the bills that you pay, so we stated we have various types of them. So we have the bills that you pay at the end of the month in terms of light bill, the rent, any overhead expense that you pay, okay, maybe business permits, contribution that you make, any other overhead expense that you buy other stuff, administration expenses, all this expenses that you incur within the month, okay. So you have to also calculate that one. So you have to keep records of this operating or administration expenses. Yeah. So we have what we call the financing cost. So the financing cost is about interest. If someone has given a loan, definitely you have to pay an interest, right? Yeah, so interest and maybe what we call as of amortization. So when you take loan, definitely you have to pay back with interest and even depending on whether it's a flat rate deduction or balancing. I've forgotten the term. Yeah, so balancing method. We have different methods that banks would deduct their loan from you. So we have so we have the financing cost. We have the profit before tax. So this is the most important part that we are going to. This one is about calculation, so kindly take note of it. So your profit before tax, so the profit that you make before the tax man comes in here, you understand? So if you don't know all these things, then when the tax man comes, where he's going to start from, maybe if you are not keeping records of all these things, maybe your social security, your depreciation, owner's salary, other operation expenses, when the tax man comes, what he's going to do is that they are going to take your cost of goods sold, they will deduct it from your revenue in order to get your what we call as a gross margin or gross profit. And then they are going to take a percentage, okay, depending on the type of tax, whether value added tax, whether income tax, whatever. Then they are going to apply it to your gross profit or margin. So they will simply deduct this from that, and then they will apply that particular, whether 20%, 10%, whatever rate that they are using. Then you see that you end up losing. But if you are keeping proper records of this, then they will rather come here, which is what the profit before tax. Okay, so the profit before tax, what profit are you making before they tax you? So you have to deduct all these things, all this cost of goods sold, your labor cost, your social security cost, your depreciation cost, owner's salary cost, other operation expenses cost, okay, and your financing cost. You have to deduct everything from your revenue. Okay, so after you deduct those costs, okay, from your revenue, what is left? That's what the tax man will now tax you. You understand? That's what they are going to apply that tax on. But if you don't keep records of these things, then it means that they are going to start from here, of which the value will be very big, and you now be complaining. You understand? So you have to do the right thing by keeping records of all these things. Then the tax man will now tax you on that profit that will be left. You understand? Yeah. So now, so we have as you determine your profit before tax, then the profit tax, the value of the profit tax will now come here, of which depending on the rate that they use, so either they will take 20% off your profit before tax. You understand? So we are going to do example of it, and then we have profit after tax. So what will be left with the business after the profit man too has taken a share from the business? You understand? So so you now what do you call it? So you deduct the tax amount from your profit before tax in order to get your profit after tax. Then you at the end of every month, you also need to determine your cash amount at hand. So how do you determine your cash at hand? The cash at hand could be maybe money in your Momo account, the cash sales that you've made and you've not maybe sent it to bank, the money in your bank account. So you sum everything up, and that one becomes your cash at hand. You understand? Yeah. So